Welcome to Tech Money Madness, your daily U.S. stock market deep dive. It is August 7, 2026. And, imagine waking up, pouring your coffee, checking the market, and just seeing a relatively quiet healthcare software stock literally double in value overnight.
Yeah, just a casual, 100% spike before you've even finished breakfast?
Right, exactly. But then, at the exact same moment, the global oil supply chain is basically teetering on the brink of this massive disruption.
And we also have the U.S. labor market flashing this, a highly deceptive warning sign that, frankly, we haven't seen in years.
Yeah, so today we aren't just reading you the tickers. The mission today is to unpack this massive real-time collision we are seeing.
It really is a collision.
It is. It's infinite tech wealth creation on one side, just rubbing up against these heavy physical world constraints on the other.
And the contrast on the board today is just stark. If you look at the major indexes, the fluctuations are really intense.
Oh, totally.
It's like we're watching two fundamentally different economies trying to, operate on the exact same planet.
Right. You have the broader market sentiment being so heavily steered by a tech sector that basically seems to believe gravity no longer applies.
Exactly. While the traditional legacy markets are just desperately trying to price in some very grounded, very real geopolitical and macroeconomic friction.
And for you listening, trying to navigate this kind of contradictory environment can feel incredibly overwhelming.
Oh, absolutely.
So we want to be your navigation guide here. We're going to help you separate today's surface level noise from the actual fundamental mechanisms that are essentially rewiring the global economy right now.
And you really cannot analyze this market without starting at, silicon and software.
Right. Let's follow the capital.
Yeah, because they form the absolute center of gravity for global liquidity right now.
And obviously, the undisputed heavyweight champion in that arena remains Nvidia. They're the most active stock on the board today, right?
By far. They're just continuing to ride their dominance in the AI infrastructure market.
Yeah, they're posting these staggering earnings growth numbers and basically dragging the rest of the sector along with them.
Well, and we also saw Microsoft post highly optimistic fiscal 2027 guidance today.
Right, and Amazon reported incredibly strong numbers too. But, the piece of news that actually caught my eye wasn't even software.
Oh, you mean SK Hynix?
Yes. SK Hynix. They just announced a $38 billion investment to build new memory chip plants. $38 billion.
It's a massive number.
Yeah.
And the scale of that capital expenditure, it really tells you everything you need to know about the current phase of this AI revolution.
Right, because they're citing surging demand and critically short supply?
Exactly. They are looking at the landscape and realizing that compute and memory, they're no longer just commodities.
They're base layer utilities.
Really?
A lot of analysts use that old selling pickaxes during a gold rush cliche for companies like Nvidia and SK Hynix.
Yeah, we hear that all the time.
But I feel like that is entirely inadequate for what we're actually seeing here. This isn't just a gold rush.
No, it's much bigger.
It feels more like the telecom companies laying down the transatlantic fiber optic cables back in the 1990s.
Oh, that's a good comparison.
Or even building the national power grid in the 1930s. SK Hynix knows that no matter which software company actually wins the AI race, every single one of them needs this massive physical infrastructure to plug into.
Yeah, they're literally building the grid.
Right.
And that is a much more accurate framework, honestly.
Yeah.
The market is actively rewarding these infrastructure builders because their revenue models are perceived as structurally guaranteed.
Because you can't bypass them.
Exactly. To train and run these massive language models, you need the physical hardware. You need the memory chips.
Right.
So the investors that are pouring capital into SK Hynix, they're making a bet on the utility layer.
Which they view as insulated from the brutal competition happening one layer up.
Yeah, in the software application space, which is a bloodbath right now.
Which brings us perfectly to the software companies actually trying to build businesses on top of that grid. The volatility here is just wild.
It really is. Look at Airbnb today.
Yeah, surged 15% today. And why? Simply because CEO Brian Chesky explicitly announced they are, increasing their spending on AI to drive growth.
A statement of intent. That's all it was.
Literally just a statement drove a 15% spike. But even more dramatic is Doximity.
Oh, wow. Yes.
Over 100% overnight. The stock doubled because the market suddenly decided their total addressable market is vastly larger thanks to AI search.
And this ties directly into a debate that is dominating all our sources today.
Yeah.
the SaaSpocalypse.
SaaSpocalypse, I love that term.
It's the defining anxiety in venture capital and public markets right now.
Yeah.
It's this realization that software as a service, the subscription business models we all rely on.
Right, the things we pay for every month.
Exactly. They might be facing an existential threat. Investors are fiercely debating whether these SaaS companies are going to be eaten by AI.
Because AI can just code up cheaper, faster replacements, right?
Exactly. Or, on the flip side, whether they will be empowered by AI, which is exactly what we just saw priced into Doximity today.
So really, the dividing line here is the moat.
Yes, the defensive moat.
But it's not just about having a recognizable brand anymore. Like, if a SaaS product is essentially just a sleek user interface sitting on top of a basic database.
Like a basic CRM.
Yeah, say a tool that just organizes your marketing contacts. An AI agent can probably replicate that workflow for free in a matter of, months.
Easily.
So that company is a victim of the SaaSpocalypse. But Doximity operates in healthcare.
Right.
They have this massive repository of proprietary, highly regulated medical data.
And that proprietary data, that is the fortress wall.
Yeah.
Because think about it, before this current generation of AI monetizing unstructured medical data, we're talking doctor's notes, historical patient trends, complex billing codes.
Just mess of text, basically.
A total mess. It was incredibly labor-intensive to sort through. It scaled very poorly.
Right.
But now, you introduce an AI search architecture that can instantly parse and structure that proprietary data.
Suddenly, you aren't just selling software to help doctors communicate.
No, you are potentially automating entire administrative departments.
Wow.
So the total addressable market isn't just software budgets anymore, is the entire labor cost of healthcare administration.
Which is massive. And that is why Doximity's stock doubled. The market realized their ceiling just blew wide open.
It's a high-stakes, real-time sorting mechanism. The market is aggressively dividing the tech sector into structural winners and obsolete losers.
And that ruthless sorting mentality, it isn't staying contained in Silicon Valley.
Not at all.
It is bleeding directly into the portfolios of the old guard. Traditional investors, legacy industries, they're watching this tech volatility and reacting the only way they know how.
Through radical consolidation.
Exactly. The pressure to find certainty in a wildly uncertain environment is forcing this massive shift in how capital is allocated.
Yeah, we are seeing a complete abandonment of traditional, broad-based safety nets.
And honestly, nobody illustrates that better than Berkshire Hathaway right now.
Oh, it's fascinating what they're doing.
Right. Under Greg Abel's leadership, Berkshire's portfolio strategy has become shockingly concentrated.
It's unprecedented for them.
A massive 63% of their entire portfolio is currently held in just 5 stocks.
5 stock.
Including Apple, Alphabet, and Coca-Cola. And on top of that, they just slashed their position in Bank of America by 50%.
And the explicit reasoning provided in the briefings for that BOFA cut is just that it no longer trades at a discount to book value.
Right, which sounds a bit technical. So to understand the mechanics of that move, you kind of have to look at how classic value investing defines risk.
Exactly, because book value is essentially what a company would be worth if you liquidated all its assets and paid off all its liabilities today.
Just sold it all for parts.
Right. If a bank's stock price falls below that number, it trades at a discount. So you are essentially buying $1 for 90 cents.
And that 10-cent difference is your margin of safety.
Precisely. It protects you if things go wrong.
So once Bank of America's stock price rose to match or even exceed that book value, the margin of safety just evaporated.
Right. The downside risk suddenly outweighed the potential upside.
Yeah.
And when you manage a portfolio the size of Berkshire's in an environment facing the kind of technological disruption we just discussed, with the SaaSpocalypse.
You do not hold on to assets that have lost their margin of safety.
No. You liquidate and you move that capital into companies you perceive as unassailable fortresses.
Like Apple and Alphabet.
Exactly.
But I have to challenge the broader implication of this, though, because, we're constantly taught that diversification is the golden rule of investing.
Right. Don't put all your eggs in one basket.
Exactly. Spread your bets to minimize risk. But if the successors to the Oracle of Omaha are piling 63% of their massive wealth into just 5 stocks, is traditional portfolio diversification dead?
That's a really valid question.
And we are seeing the exact same thing in passive investing, too. ExxonMobil and Chevron are facing severe concentration issues within the energy sector ETF right now.
Yeah. simply because they're dominating the fund's weight.
The biggest players are building incredibly small, incredibly heavy baskets.
Well, think about it this way. In a low volatility, highly predictable market, diversification works beautifully.
Sure.
But in August 2026, with this apocalypse threatening to wipe out entire tiers of software companies, traditional diversification might actually introduce a new kind of risk.
The risk of deliberately buying structural losers just for the sake of variety?
Exactly. The concentration we were seeing from Berkshire and the top-heavy nature of these ETFs, it's a desperate search for certainty. If institutions find a fortress, they want all their capital inside the walls, rather than leaving some outside just to maintain a diversified exposure.
That makes total sense. And we are seeing that exact same defensive consolidation happening in the physical economy, too. Legacy industries are feeling the heat and restructuring aggressively.
Yeah, look at Volkswagen.
Right. The controlling families of VW are currently demanding a much faster corporate overhaul.
And it's driven entirely by fear.
They're looking at the rising dominance of Chinese auto rivals and realizing that their traditional slow-moving corporate structure is literally a fatal liability now.
And the mechanism of that threat? It's entirely about supply chain and vertical integration.
How so?
Well, legacy automakers like VW, they rely on massive networks of external suppliers, right? They have complex union contracts, these multi-year design cycles.
Right, it takes them years to put a new model out.
Exactly. Meanwhile, the rising Chinese EV manufacturers operate with ruthless vertical integration. They often control everything from the battery minerals all the way up to the software stack.
Which means they can iterate and drop prices much faster.
Incredibly fast. For VW, moving slow and steady is no longer safe. It's a guaranteed death sentence. They have to consolidate their operations to survive.
It's just a brutal environment for legacy players. And we're even seeing it up in the sky. Private equity is actively circling the European budget airline industry.
Oh, yeah.
We recently saw Apollo's deal for EasyJet, and the sources indicate this is likely paving the way for further acquisitions across the whole sector.
Well, budget airlines operate on razor-thin margins.
Totally.
And they face heavy physical constraints, fuel costs, labor negotiations, airport landing fees.
So private equity firms like Apollo look at a fragmented industry like that, and they just see a massive opportunity for arbitrage.
Exactly. They buy up these airlines, they leverage the balance sheets, merge overlapping routes, slash redundant administrative overhead, and basically force operational efficiency.
Again, it is the market demanding consolidation to create a clearer, more profitable value proposition. But, the ultimate irony of this frantic search for certainty is where some investors are ending up.
This is the wildest part to me.
Right. Our sources note a surge in recommendations for the Invesco QQQ Trust ETF.
Yeah.
This is a fund that tracks the NASDAQ 100, and the rationale for buying it right now is its heavy exposure to AI-driven growth.
So, in an effort to find a safe haven, investors are aggressively concentrating their capital into the most cutting-edge, historically volatile technology sector on the planet.
The paradox of this market is that technological disruption has somehow become the only asset class where investors see guaranteed structural growth.
They view AI as not as a speculative venture anymore, but as an inevitable economic upgrade.
Therefore, concentrating capital in the QQQ is viewed counterintuitively as a defensive posture.
Looks wild.
It really is. But this is where the narrative hits a massive roadblock. Because look, you can build the most advanced multi-billion-dollar data center in the world.
Right.
You can fill it with SK Hynix memory chips. You can run Doximity's AI models on it all day. But if the local power grid fails or the cooling water dries up, that entire digital empire becomes an incredibly expensive brick.
Yeah, the digital economy cannot escape the physical economy.
Exactly. So let's pivot to the macro roadblocks flashing red today.
Because the tension between this limitless digital optimism and hard physical constraints, that is the most important dynamic playing out behind the scenes of today's market.
And we have to look closely at the foundation of it all, starting with the U.S. consumer.
Right.
The July jobs report is basically the primary check engine light for that foundation, and today it delivered a deeply confusing paradox.
It really confused a lot of people this morning.
Yeah. The data showed that non-farm payrolls unexpectedly declined. The economy actually shed jobs.
Right.
Yet simultaneously, the headline unemployment rate fell. It feels fundamentally broken. Like, how do we have fewer jobs but lower unemployment?
And the economists in our briefings are warning that this drop in unemployment might actually be a catastrophic signal.
So unpack that for us to understand why this is a warning sign rather than, a cause for celebration. We have to pull apart the math of how the unemployment rate is actually calculated. Remember?
Exactly. Because the headline number does not simply measure everyone who doesn't have a job.
Right.
It measures people who do not have a job but are actively looking for one. You have to be officially participating in the labor force.
So that means sending out resumes, applying on job boards, actively interviewing.
Yes. If you have been out of work for a long time and you become so discouraged by the prospects that you just stop applying, you exit the labor force entirely.
The Bureau of Labor Statistics just stops counting you.
Exactly. You simply vanish from the headline metric. You are no longer unemployed.
Wow.
So when non-farm payrolls decline, meaning companies are actively eliminating positions, but the unemployment rate also drops, the underlying mechanical truth is that a significant number of discouraged workers just gave up.
And that is a structural headwind for the entire economy. It's not a temporary dip in hiring. It's a permanent reduction in the productive capacity of the workforce.
And for investors, that translates directly into a massive red flag for consumer spending.
Right.
If a growing segment of the population is structurally locked out of the workforce, their disposable income evaporates.
Which eventually hits corporate earnings across the board, no matter how insulated a tech company thinks it is.
Absolutely.
And while the labor market is quietly shrinking, we have a very loud, very external shock playing out on the global stage today.
Yeah, the geopolitical situation.
And obviously, we need to examine this strictly by analyzing the impartial facts from the briefings and their tangible market impacts. But the data indicates a severe escalation in tensions between the U.S. and Iran across the Middle East.
The rhetoric has hardened significantly.
It has. The briefings quote Iran's chief negotiator directly accusing the U.S. of engaging in, quote, theater diplomacy.
Which implies the diplomatic channels appear to be breaking down.
Right. And the conflict has broadened its physical footprint. We are now seeing renewed, credible threats to Gulf energy infrastructure and critical shipping choke points in the region.
And people forget, the global economy still runs on physical shipping lanes and petroleum.
It really does.
You cannot move physical goods across oceans or power the national grid required for AI data centers on software alone.
Right.
Any threat to those Gulf choke points is a direct threat to the physical supply chain.
And the market impact is completely immediate. Oil market volatility has spiked today, pushing the average price of gasoline to $4.06 a gallon.
And when the consumer is paying $4.06 at the pump, that economic friction is instant.
Totally. Let me try to map out the transmission mechanism here, connecting these macro constraints back to those tech stocks we started with.
Okay, let's hear the thesis.
So tell me if this domino effect holds up. Oil spikes because of geopolitical friction in the Gulf, right? Transportation costs immediately rise for every physical good sitting on a store shelf. The average consumer, who might already be feeling the squeeze of a shrinking labor market we just talked about, suddenly finds their grocery bill is 20% higher.
Right.
So what happens? They cut discretionary spending. They cancel their upcoming Airbnb trip.
Ah, I see where you're going.
Yeah. Airbnb's quarterly revenue dips, so Brian Chesky has to quietly dial back that massive AI infrastructure spend he just promised the market today.
Yeah.
Because Airbnb is spending less on cloud computing, Microsoft's Azure revenue takes a hit. And suddenly, Nvidia's forward guidance doesn't look quite as guaranteed.
It all connects.
The physical bottleneck strangles the digital growth.
The mechanics of your thesis are entirely sound. That is the exact vulnerability the market is attempting to price in today. It is a massive tug of war. On one side, you have investors betting tens of billions of dollars that the productivity gains unlocked by AI will be so profound and create so much wealth that they will just outpace and absorb the physical drag of rising energy costs and a weakening labor market.
And on the other side,
The physical realities are applying immense downward pressure.
right. So for you listening, trying to synthesize everything happening on August 7th, the overarching theme is this high-stakes contradiction.
It really is.
We have companies pouring unprecedented capital into AI infrastructure. We have software stocks reinventing their entire value proposition overnight, and legacy giants hoarding their wealth in a few tech fortresses just to survive the volatility.
While simultaneously, the physical foundation those fortresses are built on is showing deep structural cracks.
Yeah.
Workers are quietly exiting the labor force, and geopolitical hotspots are threatening the literal energy arteries that keep the entire system powered.
It's intense. And it leaves you with a really profound question to chew on as we wrap up today's deep dive.
Oh, for sure.
Based on the sheer scale of the capital moving in opposite directions, are we actually watching the global market split into two entirely separate economies?
That's the real question.
Right. One is this high-flying digital AI sphere where growth seems infinite and capital is concentrated. And the other is a grounded physical world struggling with $4.06 gas, job losses, and supply chain threats.
Yeah.
And if those two economies really are splitting, what happens when the digital wealth machine realizes the physical world can no longer afford to buy what it is selling?
I mean, structural contradictions of that magnitude, they rarely resolve themselves quietly.
No, they don't.
They resolve through extreme volatility, which is exactly why the market is behaving the way it is today.
Definitely something to ponder as you watch the tickers tomorrow. Thank you for joining us as we unpack today's deep dive into the markets. If you found this navigation guide helpful, please remember to like and subscribe so you don't miss our future market analyses. We will catch you on the next one.